Good afternoon, everyone. Did you know in 2019, 15.1 billion records were breached globally? Thank you and welcome to our webinar today. Our session is on application fraud in the digital world, overcoming the challenges. I'm Dina Hamilton, Global Vice President of Product here at Featurespace, and I have the pleasure of being your host today. Joining me is Julie Conroy, Research Director of Aite Group's Fraud and AML team. Before joining Aite, Julie spent a number of years leading the product management team at Early Warning Services, and prior to that was in product roles at a very large credit card issuer, as well as an ACH wire and SWIFT processor. She and I are joined today by Chip Kohlweiler, Vice President of Security at Navy Federal Credit Union. In Chip's position at Navy Federal, he leads the fraud management, physical security, and court-ordered operations teams. He is the primary business sponsor on driving improvements for their fraud strategy. Their key initiatives are focused in authentication and application fraud currently. Chip has been working in the financial services industry for over 20 years, primarily in fraud and security leadership roles. He started his career at SunTrust Bank and helped develop their enterprise fraud strategy and implemented multiple homegrown and commercial tools and solutions to detect fraud and to improve the customer experience during those events. Chips then went on to Deloitte, where he was based in Central Europe, developing a center of excellence for financial crime consulting and led many projects across UK and Nigeria, eventually returning with Deloitte to the US, focused in payments and enrollment-related anti-fraud projects. Just one housekeeping item for us today, or actually a couple, I should correct myself. Please note there's a question box at the bottom of your screen during the webinar. Please feel free to enter your questions and we'll do our very best if we have time allotted or left over, I guess, to answer those at the end of the session. We'll also be submitting a couple polling questions throughout our webinar today as well to solicit your feedback on some pretty, I guess I would say, topics of conversation going on in the application fraud space today. I'm going to go ahead and get us started here and ask Julie to share some of her latest research and insights on the current landscape and trends that we're seeing in the industry in application fraud currently. Julie.
Great. Thanks, Dina, and thanks to everybody for giving us some of your valuable time today. So as we look at application fraud, this has been a building problem for a number of years. And the pandemic, I think, is increasing the urgency for a lot of the institutions we're talking to really shore up their application fraud defenses as so much activity shifts to the digital channels, which are just by their very nature much more high risk. So I'm going to just take 10 minutes or so to set the scene with some of the things that we're seeing in our research at Aite Group. We're going to talk about the challenge of keeping pace with the identity fraudsters. Emphasis on reducing customer friction, even as you're strengthening your defenses, which is a really tough and fine line to walk. And then, talk about just what is happening with the pandemic and the shift to digital transactions. So we all know, if you're sitting on this webinar, you know that fraudsters love fear and confusion. It's a breeding ground for them to deploy new and innovative attack strategies. And as we look at this global pandemic, it doesn't get much more chaotic or scary than what we've got going on right now. And what we're seeing in the wake of this pandemic is that it really is putting the pedal on the metal to digital transformation. We're seeing that low touch and no touch transactions are becoming the norm. The US has tried a few times over the years to move to contactless transactions, and it's been kind of a sputter out of the gates every time. But give us a pandemic, and US consumers will finally engage with contactless cards. We've seen a dramatic shift to online shopping. I saw a really interesting data graphic the other day that showed this very steady build of the percentage of card transactions that were card not present. And just before the pandemic, we were right around 15% or so. And then you saw just this rapid acceleration, and now we're in the neighborhood of 30% of all card transactions are card not present. P2P transactions are also on the rise as people don't want to touch cash, and even if you do, there's no coins out there. So it's harder to transact with cash. And we're seeing increased use of digital banking. I did a study in some of the early days of the pandemic just to understand what banking executives were seeing in terms of changes in behavior. And we were seeing, we saw an immediate 250% increase in digital channel usage. That has been sustained. There's been some interesting data points coming from the public filing disclosures of folks like Wells Fargo and US Bank. Wells Fargo in their quarterly release just a few weeks ago said that in the first 8 weeks of the pandemic, they saw 384,000 net new digital banking users. US Bank said that now 75% of all of their transactions, all of their service transactions are in the digital channels. So we're seeing this dramatic shift, and we're all forming new behavior patterns and new habits. So even on the back end of the pandemic, once we get past this, most of the bankers and e-commerce executives that I talk to believe that many of these new behaviors are going to stick. Even before the pandemic, we were seeing rising application fraud. And so from a couple of different studies that we did recently, as you can see in the left graphic here, the vast majority of fraud executives that we interviewed for a piece of research we published in the fourth quarter of 2019, so that they had been seeing rapidly rising both attack rates in the digital channels as well as losses. And in a survey that we did in the second half of last year, where we asked about top pain points in the fraud operations, for the first time in a number of years that we've been doing this survey, we saw application fraud inch just above account takeover as one of the key pain points. And this goes back to what Dina said at the opening is, 15.1 billion records were breached in 2019. And so that just gives these organized crime rings that are behind so much of this just a ton of raw material to use as they are attacking banks, e-commerce merchants, fintech lenders alike. Synthetic fraud is a big problem, particularly in the US market. As you can see from this graphic, the majority of fraud executives that we have surveyed believe that synthetic fraud is a bigger problem than identity theft for them. And part of that is it's just so pernicious. We estimate that by the end of this year, synthetic credit card fraud alone, this doesn't take into account DDA fraud or lending fraud, just credit card, is going to cost US financial institutions over $1.2 billion. It's not just a fraud problem, and this comes out especially as I'm talking to folks like fintech lenders who tend to have a bit more of an integrated org structure between their fraud and AML organizations. There's AML concerns there too, because if you've got a bunch of synthetics on your books, that means that you obviously don't know your customer. And synthetics are so pernicious because they stay on the books typically for a long time. As we've done some studies on synthetics, we see that these organized crime rings nurture synthetics anywhere from 6 months all the way up to 5 years. And then when they finally bust out, you're usually looking at least 5-digit losses. Oftentimes, it's going to be a ring and you're looking at 6-digit losses as well. And, it's not just the losses, it's also particularly concerning and problematic because children's SSNs are disproportionately impacted by the synthetic activity. These organized crime rings, as they are building their Frankenstein identities out there, know that if they're leveraging a child's SSN as the anchor, it's going to take a while before that child is of age and actually going for credit. And so they're not going to realize that their SSN has been used for all these years. There was a study that I saw a few months ago that said that 1 in 4 synthetics uses a child's social security number. One of the other key trends that we're seeing, and this was something we were seeing before the pandemic, is that mule accounts are increasingly a concern for financial institutions, and we're seeing that concern accelerate in the wake of the pandemic. We published a report a few months ago looking at how financial institutions are tackling and detecting mule activity. And as you can see from this graphic, 22% of the executives that we surveyed in the second half of 2019 had already made some investments in mule activity detection. Another 50% plus had it on their roadmap over the next couple years. What we've heard as we've been talking to a lot of financial institutions in the past few months is that they've seen a lot of online account openings that turned out to be tied to these rampant mule recruitment scams and schemes out there, capitalizing on this newly vulnerable population of folks that are unemployed. And we're also seeing a lot of mule payment activity and sharp upticks in mule payment activity as these organized crime rings have very successfully defrauded unemployment agencies as well as the PPP programs. So, before the pandemic, a lot of the uptick in detection activity was related to just the instrumental role in Mule accounts in defrauding faster payment schemes. But now that we're in the thick of the pandemic and we're seeing so much fraudulent activity as a result, I think the Mule account detection is even more of a priority for a lot of the banks we're talking to. So with that, I'm going to turn it back over to Dina, and we can jump into our discussion here.
Sounds great. Thanks, Julie. I think what I'd like to do is spend the next few minutes with Chip to explore identity theft a bit further and talk about how that's being capitalized by fraudsters today. And Chip, what are you're seeing in your area and speaking with your colleagues in regards to in the financial sector?
Yeah, I would add I was hoping for a little more votes on the over 50% category, because misery loves company, and that's where we are. At least on attempts, we're able to detect the vast majority of it. But we started to see a really significant spike in Q2 where compared to Q1 in our 2019 levels. Just to put a little context, when I say significant, it doubled in Q2. And then in July, we saw another 70% on top of our Q2 levels. So it hasn't leveled off yet. But I do want to take a step back and just go over a little bit of the taxonomy that we use when discussing identity fraud. And Julie mentioned some of it, but we break ID theft down into traditional identity theft, where somebody's using someone else's whole identity. And actually, that's what we're seeing the bulk of, and we're tend to be much better at that, and we've been doing it for years. Where synthetic identity is kind of the other big bucket that's a little harder to detect. And as Julia mentioned, the Frankenstein identities, really name, date of birth, social, don't connect to any particular real live individual. The synthetic buckets are really, it can be further broken down into people that are manipulating their own social. And some of that is sort of a credit repair type process. But it's also then sort of a third party synthetic where that is really where Frankenstein lives to create havoc. There is also, when you talk about application fraud, there's just your garden variety first party fraud that often lead to bust outs and other things. Sometimes it's a good member that got caught up in a scheme. You see a lot of people that fall for Instagram schemes and some social media, especially when they're out looking for some extra funds. Those first party frauds, they have some unique elements, but they're really better detected with your underwriting controls rather than your traditional fraud controls, because it really is the real person that you're dealing with is from an identity perspective. Relating back to what we attribute some of the increase to as far as an organized ring, there is definitely an aspect of organization around this to our spike. In May, we learned of an organization of Nigerian fraudsters called Scattered Canary. Hadn't heard of Scattered Canary before, but they actually have been around for a number of years, and Agari security firm has done a lot of research, and you could actually Google Scattered Canary and find out a little bit more about them. But one of the things that they do is they use Gmail. They create Gmail accounts and they use basically a dot account. So they put dots in their accounts so that they can create multiple identities on their targeted websites, but they can control them all with sort of a one super user because Gmail ignores those dots. Not actually a feature I knew about until recently. And what we saw was, and what was written up in some of the papers, was that they were targeting the unemployment insurance with the various states, and it started in Washington, but it really, you know, we're dealing with dozens of states right now, and ultimately, you know, it was pretty easy to see that there was some pretty significant red flags. You had multiple unemployment payments coming in. You had, you know, name mismatches. You had people that lived in Virginia getting you know, unemployment from Washington, and you know, the fraudsters start to realize that we were catching on to their red flags because they were bright red, and they said, well, wait a minute, we have all this data, right? You talked about how much data had been breached last year. They actually probably had plenty, even if 0 data records had gotten breached last year, and so they said, well, let's start opening accounts in the name of the person that we're about to submit, you know, unemployment insurance fraud on. And so we started to see a uptick of that. And it was, you know, the red flags got less red, I would say. You were able to, the name mismatch, for instance, went away. They would be able to take an address, you know, instead of just, you know, sending it to a mule as part of a romance scam in Virginia, if they were going to use pick on Washington, they could just say, oh, well, let me take an identity that I have in Washington and use that and open the account in the name of that person in Washington. So it got a lot harder to detect, and we've been working with the states, or trying to work with the states on frozen funds and get them back. But it is definitely a cat and mouse game, no pun intended when talking about canaries. So we don't know if it's scatter canary attacking Navy Federal. We definitely saw that Gmail.email pattern that I was referencing. We do use various link analysis tools and fuzzy matching algorithms to link to suspicious activity. We use linking around IP devices, email, phone numbers, and over 90% of our email increase is related to a ring that we put together, and we're working with law enforcement on. So the fraudsters tend not to create boundaries like we do sometimes within organizations. So these fraudsters haven't just been picking on the states. I don't mean to imply that. We've seen them with the identity theft accounts that have been open to apply for consumer lending products as well. So it's definitely been a problem. I do want to discuss our control environment a bit, a little bit how it's evolved, and you know, where we're going, because I think that's where we're going is probably more interesting. But when I first joined Navy Federal 4 years ago, we were actually in the middle of an even bigger identity theft ring centered around credit card fraud. The volumes were tremendous. We actually peaked at about 1 in 3 online applications being fraudulent. Our control environment was actually pretty effective. We detected and prevented about 95% of the approved credit lines from being used. But the reality was we did see that our controls needed more work to be able to scale. And we began shifting from a rules environment to start leveraging models. We also, as a credit union, we're a little bit different than banks, because we have membership where people first join and we do our KYC, and then you have your product applications. And we needed to do a better job of connecting the dots between the membership application and the product applications. So we had dabbled in some machine learning for our membership identity theft model 4 years ago, but we went from dabbling to really investing in it, both in people and in our data environment. We upgraded some of the algorithms we use. XGBoost is one of our more powerful algorithms. No Q&A about what our current algorithms are, because I would have to connect you with our data scientists, which I'm happy to do offline. We hired people much smarter than me that do a much better job of that. So we've built models for our various loan products as well, where a couple of years ago we didn't have that. So now we have auto loan models, we have credit card models, we have personal expense loan models. We definitely saw a shift in the fraud. So if we deployed one model, say credit card was the first model, we started to see more personal expense loan frauds. And you know, it takes time to get the data, find the data, figure out which features you want, and then and then deploy that model to production. So the fraudsters definitely followed the path. But again, we needed to figure out how do we scale. As Julie mentioned, some of the synthetic fraudsters, make it harder to connect between membership and the product applications because they're very patient. They have multiple identities, especially the really vicious ones. We are always on the lookout for more data. We're looking to leverage behavioral analytics. So how is the member interacting with the website? How is the fraudster interacting with the website? Are they tabbing through it? Are they copying and pasting data? Over the past year, we've done numerous POCs with third parties looking for additional data. Really focused on synthetic because we know that's where we can improve more. And we'll get to some more of that detail later. But I do want to, one of the things we're excited about in the second half of the year is the ECBSV going online. So we actually applied to be part of the pilot program, so we can do Social Security validation directly with the SSA. After going through it, we looked at the costs and the options, and we decided that we would be better served going through a third party rather than going direct. But the reality is we're going to get data directly from the source rather than from the bureaus, and we think that's a much better way to go. I think what the false positives are is going to be a little hard to say at this point, but at least then we'll have, if you start to talk about what the goods or the bads, you really take out a nice chunk of the population where it still could be true name identity theft, but you get a much smaller view to start to put additional controls on and really figure out if you have something synthetic going on. So as far as the machine learning platform, that is data, right? Like even if it's a 20% false positive rate, which I think would be high, but if it was, you could feed that data into your machine learning platform and try and figure out with other features what matters and what doesn't, and put those controls around. Ultimately, we're trying to make the appropriate risk-based decision. And that last statement echoes something that I think has been touched on, but there is a constant battle between member service and fraud detection, right? So, we want to have more members. We want to enable them to have more products, and we want them to have products fast. A few years ago, our credit card team came to me and they said, hey, we want to do instant card issuance. And I like, fantastic, but our fraud models that I just talked about, they don't run in real time. And they don't run in real time, not because I don't want them to run in real time, but we don't have access to the data today in real time. And so, thankfully worked with them and said, hey, our instant card issuance, can it really be 24 hours? Because, if you give 24 hours, then our fraud models can run. And so instant card issuance turned into 24-hour issuance, which is where we are today. But, you never want to be in the position to say no to the business, and we had to work with them. But they've been a great partner as we started to scale out our data and modeling platforms to say, hey, if the business wants to do X, then we've got to be able to do Y so that we're not creating a bigger problem downstream. So.
Thanks, Jim. I think it's some of the points you made, like for those of us that have been in this fraud industry for a long time, like the three of us, I guess, actually on this webinar today, a lot of this actually comes back and is cyclical in nature, or things in patterns move to different channels as we put in certain things, as you said, like moving from the loans to the cards or whatever, based on where you put your models and where you start flagging things. But I think the one thing about application, when you first started talking about it a few years ago, was first party fraud. That's what we were all talking about. That was the big buzz, and what were we doing to address it? And then this whole world of synthetics came into play, predominantly, as Julie mentioned earlier, in the US. And then the focus was on, because I remember back in the credit card days, we would look and see, we were always checking the obituaries because we had to shut accounts down and things like that. But now people were checking them because all of a sudden that name will randomly appear, 6 months, unfortunately, after that fact, and it's a net new card or a net new application that's coming in. So I think the whole world of synthetics and how those IDs are manipulated or even created, I guess, seems to be the biggest topic or a subtopic within application, almost like overtaking the term application fraud. Actually, it's always synthetic fraud this and synthetic fraud that. And I guess I would just kind of want to revert back. Julie brought up some interesting statistics earlier in the presentation today, and Chip, you've touched on it a bit more. I guess Julie, what are your views on this rising challenge and how it's morphed and taken over the whole world? I feel like sometimes synthetics is the word used more than application fraud, I guess. What are your thoughts on that overall, and what are you seeing when you talk to people across the globe, the U.S., I guess I should say?
Yeah, so I think, that where it's getting so much buzz is that it's still just this, kind of amorphous thing that nobody really knows how big their problem is, or very few, because so much of it does go into the collections queues and it gets written off as credit risk. It's a never pay default, it's a straight roller. OCC guidelines say you have to write that off. But as I've done some research into this topic over the years, and I have talked to folks that have brought in some consultants or whatever to do some analysis of their portfolio. There's some pretty scary numbers associated with how big our synthetic problem is. I was actually just talking to a fintech lender a few months ago, and the head of fraud there had been there for about 18 months. I've known him for many years. And one of the first things he did when he got in there was to analyze their existing portfolio to determine how much what they had on the books was synthetic. And it turned out to be somewhere between 10 and 15%, which is just a huge number. But that's pretty consistent with the credit card issuers I've spoken with as well, that have brought in some folks to do some analysis of either their credit write-offs or just portfolio by portfolio. It's a big chunk, and it's because in the reason why we have a bigger problem than some other countries is it's relatively easy in the U.S. market to establish this synthetic identity. These organized crime rings, they play the long game. And so there was, for a report I wrote a couple of years ago, there was just a small credit union that I interviewed. They were less than $1 billion in assets. And they had just within the past few weeks determined that they had taken $200,000 in losses from a synthetic ring that had targeted them. They'd opened up a bunch of accounts. 6 months later, those accounts then applied for credit card. There was a HELOC, there was some auto loans. And after 18 months, they busted all of that stuff out, and, $200,000, which is a big loss for anybody, but especially a credit union less than $1 billion in assets. So I think certainly the third-party fraud is still out there. There's a lot of identity theft, but the real big money out there is the synthetics, because it takes so long to find it, if you ever do.
I was going to say they give patience a whole other world, a whole other definition, because I feel like they have more patience than many of us, the fraudsters, do. And I think that's probably a misconception when you look at fraud in other areas. Like when it comes to this type of fraud MO and how it works, right? They do play the long game. They will ride it out. They will wait for whatever period of time they feel to make that bust out. I believe just focusing, I have another poll so we can ask the audience.
While you're launching that, I will just add that I think one of the big challenges with synthetics, and Chip probably feels this as well, is even if you've got synthetic models at the front door, it's what do you do with it when you find it? Because if they have established these synthetics and they've already set up a mobile phone number in the name of that synthetic identity, so OTP doesn't work. You can't ask KBA questions because they've already established the history associated with KBA, so that doesn't work either. So the what do you do with it once you find it is a big challenge.
Well, and that's a good question. So we'll let the poll. So again, our poll today is what portion of your credit losses are tied to synthetic? And again, so to everybody's point, understanding what you have and what you're actually faced with, right? So which is why we have the I have no idea kind of bucket, because it is over in the other credit loss area sometimes, and we can't tell, or we can't dissect those credit losses in that manner. So again, I guess then Chip, while this is going on here and we're doing our polling, do you have any analysis on your side that you've seen? I know you touched on it a little bit earlier, but anything you would like to share with us in the relationship to the synthetic losses?
Yes, thanks, Dina. And there's a little behind the scenes magic on the webinar, but I added that I have no idea in our pre-call, because I have no idea. We have done some analysis, right? So we've talked about having some third parties in, but we ultimately decided to do some of it ourselves. And what we did was we took a look at credit cards specifically. We figured let's focus on one piece of the problem. And then let's start to look at, what about people with good credit? Because a good synthetic fraudster, right, is going to create good credit. And that's, to Julie's point, it's actually really easy to do, which is a big part of the problem. So let's kind of take the bucket of charge-offs where the credit score wasn't 700. So we looked at losses where the score was over 700. We also did further segmentation for losses that were over 720 and then over 750. So we're starting to get into really good credit scores where we took a credit loss, which, our credit risk people would be say, well, something's wrong there, right? So, when I say we looked at our credit losses, we looked at losses where the account was originated in 2018 and is charged off basically in 2019 or into the beginning of 2020. And I am very glad to see that I have no idea was a winner. So, we looked at things like, never made a payment, because that's a pretty good indication if you have a good credit score and you never make a payment that you're a fraudster. It's like a Jeff Foxworthy shtick almost, right? We looked at ones where they had a credit bureau, but not until after they were over 30 years old. Doesn't necessarily make you a synthetic fraudster, but it's an indication. We looked at ones where they asked for a credit line increase and then went bad. We looked at bust outs. We looked where there was credit bureau mismatches. We looked where their first trade line, for instance, was older than they were. And so, those are the type of things that we start to see that, yes, step one, we do have a synthetic fraud problem. We don't necessarily know exactly what it is, but we're starting to get our arms around it. And the other piece that we figured out, and I mentioned, some of the machine learning work that we're doing before, is we realized we need to do a lot better at tagging, because machine learning models do not work very well if you don't tag them very well. So most of our tagging has been really the tried and true identity theft, and if we don't start tagging things specifically as synthetic, we're not going to be able to build really good synthetic models, even with better data. And so we work really hard. We're working with our collections team on the process to tag, as Julie mentioned, the process to actually, and that's one of the reasons, again, that I'm happy about the ECBSV process, because we're going to be able to go to the source and really figure out, is this Frankenstein, or is this somebody that just got married and there's a name social mismatch, right? So those are the type of things where today we use the SS89 form. It creates a lot of friction. And again, we're trying to balance that friction and it's a very manual, labor intensive process. So being able to use electronic means to validate that will be hugely beneficial. And then for the team to be able to distinguish, hey, I'm trying to deal with a synthetic fraudster versus a potentially other type of identity theft is helpful when we develop our SOPs. So there's a lot going on there. Synthetic is a much bigger problem than kind of our traditional identity theft. And it's an evolving, I think we'll make a lot of progress in the next couple of months, but it will be interesting to see how our modeling solutions evolve over time as we get better data.
Thanks, Chip. I know we've covered quite a lot today, but I think, as we come towards the close of our time together, I think we always kind of talk about how we can collectively work together to understand and combat this surging area of fraud that we're seeing on the rise overall. And I guess I would pose to both Julie and Chip their thoughts on this, on how we can collaborate more effectively and efficiently as an industry overall. Julie, do you have any thoughts on this?
Well, we're all up against the same fraudsters, and so I do think, having collaboration and open discussion among financial institutions is, that's important. And I'm going to do a shameless plug here for a collaborative forum Aite Group is hosting in September. It's our financial crime forum, where we do bring together financial institution executives. Chip is going to be joining us there to really talk openly Chatham House rules. This year it's going to be in a virtual Chatham House format. But we just really encourage the sharing of challenges as well as best practices. I think the other challenge, especially around Synthetix, but this is really a challenge, I think, again, especially in the US market, is just around having effective benchmarking and definitions of the fraud problem. Yeah, as I've done synthetic research and I interview financial institutions and lenders, I ask them how they define Synthetix, and I ask 5 people and I get 5 slightly different responses, which makes it hard to come together and benchmark our losses, because if we're defining it differently, then you're defining the losses apples to oranges. And it also makes it harder to come together and share best practices around solutions. So I think, I know forums like BITS they're looking at how do we better establish better benchmarking and metrics, but I think that is a key opportunity for the industry.
And I definitely agree with that wholeheartedly. We don't actually belong to any of the bigger industry groups. Happy to share again offline anything specific but I think as granular as in like what's your algorithm, but what are your data? What are your top 10 data elements? What worked, what didn't work? We're investing heavily in our application fraud tool. What data sources did you prioritize? Which data sources did you not prioritize, right? Have a candid conversation with another financial institution and share like the nitty gritty of the fields and the data sources, is huge. We don't have to be using the same vendor to do email validation, but just knowing, what the lift was on your model, that's kind of nice to have. And, somebody for your data scientists to talk to. It's one head of fraud talking to another head of fraud isn't necessarily, because I think everybody has, some similar strategies, although the taxonomy that Julie mentioned and the benchmarking is extremely important, especially because this is such a gray area of what's synthetic and how big it is. But when you start to talk about like 10 to 15 or even up to 20% of your credit losses are potentially fraud, synthetic fraud, that's a huge number, right? So that's in our collections bucket, but that is, that would dwarf our normal fraud losses that we talk about. And we're to do it right is a really would be great for our members to be able to reduce the friction, but also just to make sure that we're securing the assets of our institution. So I think benchmarking and collaboration I'm 100% behind that.
Thanks, Jeff. Appreciate that feedback as always. Let me see. I think we might have an opportunity. I know we're getting to the end of our time together, but maybe we can take one of the questions. I'm going to see if I do this correctly. So let me see if I can see. So one of the questions that we got was around. So this was a question for you, Chip, actually. If you do find a synthetic that is still active, what actions are you taking at that point?
So we found one the other day, oddly enough, that had $100,000 in the account. So that one we're still trying to figure out what to do with, because that is a unique situation. But just speaking of collaboration, just yesterday I was talking to a credit union, right? And they reached out because they said, hey, we think we have a mutual member who's committing fraud. So sure enough, he had gotten a car loan with us and was delinquent. We didn't have him marked as fraud. Today, he's marked as fraud. He's marked as a synthetic fraudster, right? So we started to pull some of the data. We did some linking. We actually found, 5 or 6 other members that looked like they were related. And again, it goes back to that link analysis aspect, right? So the IPs, the phone numbers, what other data do we have that's in common with other members? It turns out there's a bank that's involved too. So the 3 of us will work together and we'll work with law enforcement. But, if it's at the very beginning and it's the membership application, then when we do the SS89 form, if it's a little further downstream, we restrict and we try not to send people to branches, but that's we have a couple of different things that we do after we restrict and ultimately we'll freeze assets or if they exist.
Okay, and I think there's one more. It says some synthetics may not be for nefarious reasons. how would you handle a deposit synthetic that is identified that may be something like an immigrant without citizenship?
That is, I'll jump in on that one first. It's a great question. That actually came up as I was doing some of my synthetic research about a year ago. It was really interesting as I was having these discussions. I was talking to banks as well as fintech lenders. And I had a couple bankers that I interviewed, and I've known these individuals for years, so they were very candid with me, but I did have some say that, there are some synthetics that are great customers, and I really don't want to shut them down because, they are illegal and this is the only way they're getting the account. Whereas as I talked to the fintech lenders, they were viewing that as a very big KYC and AML issue. And, that they were being very aggressive with those. And I think that speaks to kind of the more siloed nature of AML versus fraud in a lot of institutions versus, some of the neobanks and fintechs that have stood up a more integrated organization.
And we lean more towards the fintech route, which might be the first time I've been able to say that. So it also happens that we're integrated, right? So my boss is the chief security officer. He also happens to be our BSA AML officer. We're also, my peer is the CISO, right? So we're kind of have all the risky bad things in one group. But we definitely take the route that, synthetic is synthetic. And if you can't validate the data, then you don't really know your customer. Hopefully NCUA is listening to that too. But, from a risk perspective, it really comes about the identity. We can't take into account whether or not, how it's performing. When I mentioned the analysis that we did, that was actually something we didn't do, right? Is to look at, hey, these attributes that I talked about a little bit, are there people with those exact same attributes that have performing loans? We didn't look at that. We will look at that at some point, but that's really just to understand the business implication when we start getting stricter on the front end.
And I do think, the fact that the Federal Reserve has done a couple of studies looking at the synthetic problem in this country, I do think that's a clear indication that we're going to see more focus from the regulators on the BSA side of things into the synthetic problem, which will make it more of a shared issue across both competencies.
Okay, well, thank you both very much. I think that about wraps up our time that we actually have available today. That was the fastest 45 minutes I think I've had go on in quite some time. Julie even mentioned that earlier, that it would be pretty quick for us, only because the three of us are used to talking quite a lot, I think. So, but you can, any of the questions or chat things that we didn't get to, again, please feel free to get in touch with us at featurespace.com, info at featurespace.com, and we'll do our best to try to answer that for you. I just want to take a few minutes and really thank Chip and Julie for joining me today. I hope you found this as informative and educational as I did. And thank you all for spending part of your day with us today. We really appreciate it. Have a nice afternoon, evening, or wherever you may be calling from. Have a great day. Thank you so much.